You can crush all of your sales targets and still struggle to pay the bills and the salaries at the end of the month. So what is the difference between companies that just shine for a season and then go bust and companies that actually last? It all starts with how we measure success and how we think about what success actually means in a company. It's very easy to get swayed by the success stories and magazines and posts and documentaries. And we see these amazing companies that are being celebrated for their sales results, for their valuation, for a new partnership, a top hire, somebody they hired, somebody prominent. So there are many ways of how our view of what a successful company is being manipulated. Maybe not intentionally, maybe yes, but overall, it is not often aligned with reality of what actually makes a company successful and what it means to build a company that lasts. Now, all of this would just be mental gymnastics and would be of no further consequence if it would not influence our decisions as founders, as owners, as top managers. Because the moment we have a skewed view of reality is the moment when our decisions get tainted by it and we start making decisions that don't always give us the results and outcomes that we're hoping and aiming for. So let's start to unpack what the typical pitfalls are about companies that shine for a season and then go up in flames. It's easy to start with top-line growth, with revenue. Now, we all know revenue pays the bills. Revenue, which means when I make a sale or a partnership, whatever it is, like I have income coming to my bank account as a company. Now, that's great. That's amazing. And of course, that's the lifeblood of the company. That's one of the reasons why a commercial organization exists. But if the focus is exclusively on sales and revenue, what often ends up is the wrong metric is being celebrated. Having revenue, having sales does not mean that money is left in the bank account at the end of the month to pay the salaries, if there is no consideration of costs. And indeed, in the 2020 and 2021 unicorn era, we actually had exactly that problem, that companies and owners were asked and pushed and pressured to drive sales and revenue and explicitly not to care about costs and about margins. Now, you can do this for a while if you have a massive cash injection and funds in the millions from venture capital firms, but at some time, the music stops. For many companies, it stopped in 2022 when inflation hit and when the rules of the game completely changed when it came to fundraising. Now, top-line growth is one, and it also often can have negative triple effects, which is you have salespeople who are incentivized to create as much money as possible, to sell to as many people as possible. And if they do not care about the consequences, you will end up with a whole bunch of negative customer reviews, which will make it harder for you to sell in the future because people actually read reviews before making purchase decisions. You will end up with a lot of refunds and churn that, depending on the stage of your company, might be underreported. You might not even know about it. So while you as a company owner invite your sales top performer on a castle retreat somewhere on a mountain hill for their amazing results, probably half of the customers or half of the revenue is already gone because people ask for refunds and churned out and canceled their contracts because most of what they were told during the sales process were utter lies and misrepresentations. The next one is headcount. There's an idea that scaling a company means hiring more people. Like, you want to look like a real company. You know that the big giants, Microsoft, Apple, whatever, they have massive headquarters with thousands and tens of thousands of employees, and you kind of want to look the part. So hiring more people, obviously, it is a validation for you. You can afford playing in the big league, moving into prime location in your city, having offices that are really nice, luxurious. All of this gives you the feeling of, we made it. And it's understandable because you maybe came out of a long phase of struggling, of having your idea validated, of going through the hustle and grind where you thought nothing was working. Now finally you have the capital and you also prove to yourself that you made it. So hiring people, that's very different from running your company out of a basement. You made it. You're now part of the club. But obviously that can also turn very quickly into a vanity metrics, because the more headcount you add, the more complexity is being introduced into the company, the more coordination you need, the more unhappy people you have, because you probably do not have the bandwidth to either onboard them, train them, give them proper direction, management. Maybe you feel intimidated by some of the people that you're hiring because they are completely in a different league in terms of skill sets, track record, and professional experience, and that makes you feel insecure. Your own authority could be challenged within your own company now. So hiring also opens a whole new Pandora box of challenges for you. And yet, growing your headcount for a long time appeared to be a measure of success. But what if a lot of those people that you hire end up not knowing what to do and spending their days watching YouTube and doing other things during work because there is not enough work, not enough challenge for them, especially as it is often in sales teams. Just hiring more salespeople doesn't create more demand. More demand is created with marketing and branding. It's not created by hiring more salespeople. So just hiring more salespeople will not automatically give you more sales results. So we have this idea that having large companies, hiring more people means that we made it. It is a sign of success. It's scaling. I have a few thoughts about that, which we will also cover about what scaling actually means. The next one is valuation. Like we see all the announcements on LinkedIn, elsewhere, and TechCrunch, this company got a Series A round, they got a Series B round, and we celebrate that. Everything is like leveling up in a video game. It's like Series A, Series B, level 1, level 2, you made it. The reality is, I can go about this in depth on different occasions, but the reality is it's not always a good thing for the company. Certainly, in the short term, tactically, it is a good thing because now you have capital to deploy, to invest in expansions, to invest in market share, to invest in market share, meaning sales and marketing, to invest in hiring top talent. Also, the press release itself can attract top talent to your company that you would otherwise not have access to. We all know people in the company also have a great deal to do with the results and the outcomes of the company. There's, of course, a lot of positive side effects with it, but also it comes at a cost. And valuation is not always the best long-term, like increasing valuation is not always the best long-term game for a company, because you could also be downgraded again. And there are many factors that are outside of your control when it comes to this. But this is for a different day to go into depth. The next is media coverage. So you will find early stage startups with some impressive results who, instead of hiring a chief financial officer to actually look into the books, would rather hire a head of public relations and to somebody who makes sure that the founders get into the magazines and TV shows and interviews. And again, all of this can be tactically smart because it attracts top talent. It attracts investor confidence if your game is to go for more funding rounds. It can, of course, also attract clients. You can get contracts with enterprise clients and so forth if they see you have a market presence. If this is used as a tactic, it can be phenomenal. But often it turns into an end in itself. It turns into a strategy in itself. And it feels good, but it doesn't always translate into business outcomes at all. Again, used as a tactic, definitely, but not as a strategy. Next is symbolic assets. We touched upon it already. Think about the new office. You think about also sometimes logos. Logos meaning you acquired certain big name, big brand customers. Now, for many companies, of course, that's a good thing, given that there are actually long-term contracts in place. Most of the logos that you will see on websites or on companies are typically just doing pilots. So what does that mean, logos and pilots? Logos is basically a fancy way of saying company X, company Y, who everybody knows is buying our service, is buying our product. So I put their company logo in my slides, my investor slides on my website. They are working with us. But often, not always, but often, most of the time, they are working with us is just a pilot project. So they ask for a demo or for a proof of concept, a POC, which means, for 3 months, they are trying out our product. And then they see if they want to buy it or not. And large enterprises do this in their procurement process. And when they actually buy software and they buy vendors, whatever, when they buy services, they typically try out the product. So it doesn't really mean that you work with them. It might be that you have a try phase with them. Again, if you have a solid, legit contract, that's a different story. But also let's keep things grounded. In many cases, that's not the actual reality. And so it becomes a vanity metric because you now create an illusion of success, an illusion of safety in your business about you are successful because all these big names work with you. But that is not enduring cash. That's not long-term value. If the POC is over, if the pilot is over and the potential enterprise client was not satisfied, or they found somebody else doing it cheaper, or even they just used that POC to learn about how you do things so they can replicate it internally with their own team. So they just used it to basically steal your IP, your intellectual property. You wouldn't know. Then that logo that you have on your website means nothing. It is not giving you a permanency. It's not giving you endurance to your company, survivability and backbone. It looks nice, and again, this can be great as a tactic, but it is not a sign of running a successful company. We already touched on funding rounds, basically paper value, right? And again, for tactical reasons, great, but it's paper value at this point. But also capital raised can be, which ties into it, of course, can be one of those vanity metrics. Just have to keep in mind it doesn't really impact the shares pretty positively many times because of liquidation preferences of new investors that are coming in. And you basically then have more people eating from the same cake. And that's not always a good thing, especially not for employees who have common stock and who could be wiped out because of the liquidation preferences of late-stage investors. And now if you go mostly for those vanity metrics, or let's call them glory metrics, right? Metrics that look good on paper, like all the ones that we just noted right now, and of course there are more, but just to give you kind of a high-level overview, we end up in a position where our options for the end game of that company shrink substantially. Like we basically go into a situation of inflated valuations where we only have one of two choices, IPO or bust. And why is this? Because nobody would buy the company at the inflated value, because none of those that we just described will survive due diligence. A serious, sophisticated buyer and acquirer will most likely see through that game and see that there is not a solid business foundation and solid business fundamentals behind those metrics. And so we want to look into what does it actually take to create a company or to design the company, architect it so that it lasts and that it actually has a long-term future and long-term value creation, instead of positioning itself into an environment, a situation where it will inevitably crash against the wall. It starts with the margins and with the efficiency metrics. The top line revenue is great, but how much of that revenue do we actually retain? First of all, what does our churn or refund rate look like? Is the number that we're looking at actual reality or not? Sometimes churn and refunds are underreported, so we would not even know unless we build the data infrastructure to track those in real time. The next is, when we talk about efficiency metrics, what does my lifetime value look like? Lifetime value means of the customers that I acquire, do I upsell to them? Do I renew them? Is it a subscription model? If it's one-off transactions, do they buy from me again and again and again? Where do I stand with this? Because I have invested money into acquiring those customers. I paid marketing, I paid for performance marketing, for branding, including the press releases, my head of PR. Like I put a lot of money into getting those clients. And I also paid sales commissions, right? I had to build an entire sales team, pay their salaries and whatnot. Like, and a lot of costs to getting those customers. And now just let them go after one transaction? Or do I actually have a plan to keep them in the business, for them to continuously, increase my revenue? But also that cost of customer acquisition. Like, how much does it cost me on average to get one customer is an important metric that I should know, because it could again happen that you crush all of your sales targets and your costs spiral so much out of control that you end up paying for people to be your customer. Those metrics are also the baseline for your margins, for your contribution margins on a unit level, but also your cross margins and your operating profit, your net profit. Everything basically comes back to how efficiently you create revenue. And this determines whether you're able to pay the salaries, whether you can keep the lights on, whether you can pay the rent in the fancy office and the prime location. And so many times it's being overlooked, or these metrics are underreported, even though those are the survivability metrics of a company. Those are the ones that make sure that the company stays in the game in the long run, that it's not being surprised and assaulted by mass layoffs, and out of the blue, everything is just going bust, which happened many times over the last 5 years since the massive infusion of venture capital into a lot of companies and startups due to the low interest rates of 2020. And so once you understand your retention, your customer retention, your revenue retention, and also your margins, and of course your cash flow and so forth, your payback cycles and all of this, which requires proper finance measuring. Once you understand this, and one thing about this, often actually it requires some work, some data engineering work, some analytics work. Sometimes you need to build an infrastructure to even track those things in the first place, because if you have grown really fast, then often these reporting structures did not keep up pace and speed with the growth of the company and the growth of your revenue. Sometimes it takes massive technical effort to actually get those in the first place. And the next is governance, of course. First of all, do I have top talent, but also how is the top talent being managed? Like, how are the structures? How does my org chart look like? How are decisions being made? How do those decisions travel down the organization? What is our way of doing things? And that actually, I've seen this in practice, can often be a competitive advantage, even though your product might not be up to speed with another competitor. But if your way of doing things, if your speed to be responsive to customer needs, to be responsive to customer preferences, market preferences, if your salespeople are known to be trustworthy by the market, by clients, if your founder is somebody who always keeps their word, follows up, gets things done whenever there's a promise being made, that is your way of operating. That is actually a massive asset, your reputation. And again, your reputation, not just about being featured on the cover of a magazine in terms of status. No, your reputation of how you do things. That becomes a major asset also for your long-term survivability and your long-term endurance. And your way of doing things is something that I feel very passionate about, needs to be part of your onboarding process. I've onboarded multiple hundreds of people over my career. And I always said, onboarding is the most important thing you can do if you get any new employee, because it sets the tone for the rest of their career in your company. And you never want to be dependent on key people, on key individuals. Let's say you have a very talented CTO, like Chief Technical Officer, somebody who's overseeing the product team, the engineering team. You have a very successful sales leader. And while you honor and respect the fact that those people are there, it creates a risk, because if they leave the company, of course, it will create a massive disruption. And sometimes people leave even for reasons that had nothing to do with being unhappy, but maybe they have personal circumstances, family circumstances, or other reasons to leave. And so onboarding actually creates for you a pipeline of people who act in the operating system of the company, what made the company successful. And you spread this way of doing things across as many people as possible. And if that's the first thing you get exposed to at the first day in the office, at the first day in your company, that typically sticks with you. And I always say, you can have a highly talented person, throw them into the company without onboarding, without training, without any guidance. They will somehow figure it out. But first of all, they will probably need 6 weeks or sometimes 6 months to figure it out. So during that time, you're paying salary for very little return on investment. Most of them leave anyway, or they get so demotivated, or they realize that not much is asked of me here anyway. The expectations are really high. I might as well just do the bare minimum to get by and cash in on my salary. If on the first day of your job, you actually get exposed to people who embody the way of the company, you are switched on a bit differently. If sessions start on time, if there is a friendly but firm atmosphere, if it is clear about what is expected, about how things roll here, it will now create the tone for you. And the same person who could be a high performer who then chooses to underperform, you can have a mediocre person who, based on that onboarding, will actually overperform, because they realize, here, this is the tone, this is what's being asked for. And also they can self-select themselves out during the probation period if they realize, due to the onboarding, this is not for me. And this becomes an asset to the company, to the long-term company value, because you want to know that every time you hire somebody new, that person creates return on investment. It's not a gamble, it's not guesswork, it's not hoping that they will perform or not. You actually have a structured method of bringing them in such a way that they will perform. And if they don't, based on the shared and clearly communicated expectations, you will also be able to separate ways way faster. So onboarding, governance, and also it goes back to decision making, like how power decisions being made, who makes decisions, who has decision-making authority. All those things matter, and they often matter more than just getting revenue or getting press releases. The next is scalability. The, let's call it, superficial view of scaling, as we discussed already, is add more headcount, move into a bigger office and whatnot. And then you just end up overhiring, overspending. And I mean, then to some degree that was even encouraged in the 2020 era. But the problem is, back then there was this, let's say, allowance or tolerance of having a high burn rate. Burn rate basically meaning you're losing money every month, and you accept that from tactical point of view, as long as it would potentially give you more market share or more long-term success. And then later on you figure out, of course, all the efficiencies. And then often where the people spend the most money on, right? Vanity things like, or symbolic assets like a big office is one of them, but mostly in hiring and marketing. Now, these, and often those end up being your biggest expenses in the company as well. So you start overhiring, you start overspending on symbolic assets or marketing. You put marketing in the marketing budgets on very inefficient channels. You don't even care much about which channels perform well. Maybe you don't even have a tracking system of this at all. You just hope that pouring money into marketing will give results. Hiring more people means that there's more productivity in my company. Often, of course, the inverse, the opposite is true in both cases. With overspending marketing, you can also burn bridges. You can burn trust in the market if you come across as too pushy, as too annoying, as too much into people's face, especially if your messaging is not on spot or not even well thought through. Same with hiring. You think that bringing in more people will bring in more productivity. Without an onboarding process, without actually thinking through the whole thing, you would just end up with more complexity, with more people to manage, with more managers that you need to manage those people who are equally sometimes clueless because they have not been onboarded. They also just try to figure it out as they go. And you don't have the bandwidth to pay attention to all of those people and what they do performance reviews, set criterias, and you just end up overwhelming the organization. At some point, you need to do mass layoffs. Happens to many organizations or many companies. And a mass layoff is typically only survived by extreme demoralization, and most good people leave afterwards because their trust in the company is gone. So, and then those who stay sometimes stay out of fear, sometimes stay out of comfort, sometimes stay just because they don't have other options. These are not always your A players either. And so you really run into problems with overhiring and overspending. So that's not scaling. Scaling is really that the more volume you get in, the lower your costs are and the better your margins become. Scaling is about efficiency. Scaling is not about inefficiency. Scaling is about efficiency. That means that the larger the scale, the more volume, the higher the scope of what you do, the more efficient you become, the more successful you become. And that can only be designed. It cannot be created by chasing symbolic success. So ultimately, you want to build the company and design the company for durability, transferability, and resilience. You want to make sure that you have more exit doors open, that you can actually be acquired by private equity or by a strategic buyer, and that you are set up for success for the long run. And most of those metrics are really boring to brag about. It's really boring to brag about customer retention or lifetime value or bringing down your cost of customer acquisition. That's not flashy, that doesn't make the headlines, but that is actually the difference between individuals and organizations who either chase validation or validation in the sense of external validation, or actually change results, outcomes, and also live up to the responsibility that they have towards their investors, their vendors, their employees, and their customers.